The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. Did I say president?
No, you said president, grand poobah, CEO, CFO, something.
Well, that is Guy Allard, my co-host. How you doing, Guy?
Hey.
I just want to warn the audience right now, Guy
Uh-oh.
is on some muscle relaxers throughout his back, and
what are you trying
he might say something funny.
You trying to preempt any mistakes?
Just in case anything's out there.
Muscle relaxants, painkillers.
Oh no, those are always fun. They put me to sleep.
I went to the acupuncture first, and he goes through and we have a good one that we've used and has helped us in the past. And he goes through all the stuff, and he says, "No drugs." So just to double up, I go to the GP the next day, shot of cortisone, muscle relaxant.
That's right. You got to do both.
What are you going to do?
Oh, I went to. I won't mention his name, but I went to him and he said, "No drugs." I'm like, I walk out there and go, "Oh, well, I'll get some. If I need them, I'm going to get them." There's a reason why I do it.
I remember back 10, 15, how long ago was the KRLD seminar, Money Matters, at the hotel that we did there?
Probably 15 years ago.
15 years ago, they called me 2 days before the seminar. Seminar was a Saturday, so I guess, or didn't call me, the CFO at the time before you bought the business, sat me down and said, "Guy, we're going to need you to do the seminar." Nothing written, no preparation.
I was supposed to do it, that's right.
Victor is supposed to do it. Short story long. He threw his back out, apparently opening the back door to let his dogs out. Something really difficult,
right.
Like balancing 200
Actually,
pounds on one leg.
I went to pet my dog in the head and stuck there for about 2 hours.
Oh! But anyway, where I was going with the story, Victor loaded up on like 3 hydrocodines and muscle relaxants and probably gave one of the best seminars of his life. It was pretty good, actually. Didn't feel good from the inside out, though, did it?
No, I was limping around there. No, I knew I could make it. It just, I didn't know how. I didn't drive, though.
Victor used to start the seminars out with, he'd have a fistful of magazines, money magazines, all the big ones that you read about the top 100 mutual funds, where your money should be, and he shows the audience the magazines and immediately throws them 3 rows deep into the audience. Now forget about all those. Right?
That's right. I don't think I could do it that day. I might have chunked him about a foot.
Yeah.
Well, let's talk more about the Trump effect to the market. What it's doing. You've seen the market rally since he was. And it's not unusual for markets to rally after an election and maybe settle down a little bit at the inauguration time.
And just a small, tiny 100-point hiccup earlier in the week with the Fed quarter-point increase.
That's right. Feds raised interest rates a quarter point. They raised the Fed funds rate, which all the other rates are based upon. And so, therefore, everything gets a little more expensive. Credit cards should cost more, even though they were already screwing your eyes out, right? They're 29% when the Fed funds rate was 0.
Any of these cards that offer you cash back 1.5%, 2%, or free airline miles, if you carry a balance on those, they skin you.
Mortgages going up, stuff like that. That's what I was talking a little bit about. Jeffrey Gundlach. He's a CEO or chief investment officer of Double Line Capital, a big bond house, and they're talking about what happens if the 10-year treasuries. We've been talking on the air about them. They got down to about 1.7 in the summer, back up to 2.5 now. He says if they get to 3, 10-year treasuries get to 3, it could be the tipping point of stocks and bonds. And so I was like, oh, that's interesting. Why is that? Well, at 3% on treasuries, then people start rethinking being so much heavy in equities. Because right now, when you got a CD paying 1%, 10-year bonds, we're paying 1.5 or something.
There's no money there, is there?
That's right. There's no money there. Might as well keep it in stocks. But when you start getting 3% on a treasury, which is considered riskless, right? Then people start going the other way. Also, what 3% when the 10-year treasury means is interest rates for mortgages should have gone up about 30%.
Home buying slows down,
Home buying slows down, resales slow down,
or prices come down
prices come down
to
to
compensate.
because remember, people don't buy an interest rate; they buy a payment.
That's a fact.
That's why the car dealer's been.
What do you want your payment to be?
Yeah,
What does that
killing
have
it.
to do with the price?
That's why when you're doing a car deal, get the price. Don't
Oh,
worry,
doubt.
negotiate the interest rate afterward, because they'll get your payment where you want it to be.
And keep in mind, we'll go a lot more into the 3% potential of the bonds and all of that, but there's a lot of dynamics involved. A lot of people are already in cash. They don't want the risk of the market. They're not going to take what's in CDs, so they're really sitting on the sidelines, so that money's out. There's a lot of people that will allocate their portfolio and certainly put some on the safe side where they can get these guaranteed rates, but that makes sense. But hopefully the money left in the markets with the Trump effect and with the lowering of corporate tax rates and hopefully with the business stimulus and all of that, they'll be doing better. So that'll certainly compensate for some of the money coming out. There's just a lot of dynamics. It's a very fluid situation.
That's about 11% of the general revenue comes in from corporate taxes. So some will say, well, if they lower those taxes, that's going to go down. That's true, but also companies could retain more earnings to pay more taxes. Even though it's a lower percentage, you might be paying more that way. Also, consumers, if they're getting a tax break, could spend more money, so that can help the economy. There's a lot, there's both sides to every single thing there.
And then,
in general, lowering tax rates help an economy.
And then you've got the whole repatriating of funds too, with that rate and the forgiveness on some. So there's just a lot of things going on. The smart people, like most, will stick their toe in first and then their foot in, and they'll inch in and get acclimated, make sure that things are in effect and that they're working the way they should be.
Right. The sectors of this year, like the market's gone up, several percent since Trump was elected. Financials doing really well. Industrials, energy. You remember seeing the oil prices getting above 50 again?
That's right.
The ones that have done poorly have been healthcare, consumer staples, and utilities. It's weird because I see both sides. Healthcare, I'm wondering why has healthcare gone down for a month or so. A lot of it is they're saying they're going to get rid of Obamacare, but I think that would help healthcare because most of the people that signed up were the ones with pre-existing conditions, but I don't think Trump's going to lift that. So maybe that does hurt their bottom line.
Well, and I tell you what, right now with the Trump effect and people have a pep in their step, you want to be ahead of the game. You don't want to be the person chasing. In other words, when market's already up, you get in before it goes down and vice versa. So there's some really good things you can do right now to take advantage of the Trump effect while still taking care of being conservative and being cautious with your money. One of the things is our money managers at Fidelity is a sector-based deal. So they're not, you're in the market. Now what Victor's saying, the sectors are changing. Some of the ones that were doing very well aren't, and some new ones
That's right.
are kicking up.
Remember, we believe in protection. Protection is the name of the game here at Dillon Gage. Protection. So our philosophy is to get a guaranteed income stream to pay your expenses for retirement. Even if you're 10 years to retirement, you can put a third or fourth, fifth the money now to secure that same level of income. The rest of it goes into the market. But when the market hasn't gone down in 8 years, no matter who's elected, you need to protect that piece as well. And so that program puts you in every sector of the market. If any of those sectors start going down below their moving average, each one having its own moving average, and then it automatically pulls you out of that sector.
And this is a perfect time for that sort of thing.
That's right. Because sometimes if I'm in the market's crashing, the overall market, but there's a couple sectors that are pretty good. Like sometimes when the market's crashing, utilities do real well. Well, I want to stay in those. So it keeps you in the ones. Some other competing programs out there take you completely out of the market and put you in cash, and they're still charging you 1.5%. Why? You could be in cash for 2 years. This doesn't charge when you're in cash, and it always is in a sector that's not gone down. And so I think it's a more effective, more comprehensive way to protect a stock portfolio, and it's 100% liquid at all times. Like all managed programs, pretty much universally charge you a quarter in advance, but we'll rebate anything if you got out the next day. They'd rebate you everything but that day. If you have any questions or like a free information kit on our managed program, don't hesitate to call 972-715-2424. Also, if you'd like a way to secure your retirement or retirement income, again, 972-715-2424. All right, today's show, we're going to talk about some of the stuff with IRA survivorship. We're going to talk about that, like Social Security survivorship.
You're on my codeine and what over there?
Also, when you inherit an IRA, there's some special rules and some little pitfalls that you might get hooked into and you didn't realize, and it will cost you a lot. And so you're going to want to stick around, after the break, because we're going to talk about when you inherit an IRA. If you're a spouse, if you're a non-spouse, when how do you take Social Security if your spouse dies? There's a couple different ways. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, folks, if you'd like to take advantage of our no-cost, no-obligation retirement plan stress test, and Social Security Optimizer, don't hesitate to call us at 972-715-2424. These will show you if you have a possibility of running out of money with your portfolio. It'll show you the effects of inflation on your expenses. It'll also maximize your Social Security benefits. Put all that together to give you a really solid plan. It shows you what your life is going to look like at 60, 70, 80, etc. There's never a cost and never obligation, and it's the most comprehensive plan I've ever seen. So call them 972-715-2424. You can always go to our website at ilovemyretirement.com. Remember that the website has some good videos in there. There's new stuff put on the, I think it's the research page or the information page every week. Again, ilovemyretirement.com.
Before we went to break, Victor, you started talking a little bit about inherited IRAs. I think we're going to get into Roths, but the best thing I could say is if you've inherited or you're in a position where it's imminent to inherit an IRA or qualified money, please feel free to call us. There's a lot of pitfalls. We'll go through some of them today. We went through some last week as far as where to put it, where not to put it, as far as into these REITs and things, because it could expose your whole IRA to taxation. So there's a lot of, like Victor was saying earlier, pitfalls, and be very happy to share those and just make sure we can give you some guidance so everything is done properly.
Yeah, people pretty much know a lot of the basic rules.
Right.
If your spouse dies with an IRA, if your spouse dies with an IRA, you can put that IRA in your individual name. And what happens is when you reach 70 and a half, you have to start taking required minimum distributions. Even if your husband or wife passed away at 50, it's going to be on your age at that time. And so you move it into your name and start taking RMDs. Now, the confusion usually comes when it's not a spouse that inherits an IRA.
Correct.
When a non-spouse inherits an IRA, they have to start taking RMDs the year after the person passed away. Okay? They have to take these. And another one, remember Roth IRAs. Roth IRAs, they're after-tax money that grows tax-deferred and comes out tax-free, as long as you hold them 5 years and you're over 59 and a half. Well, Roth IRAs have RMDs if you're not a spouse.
And normally they don't.
That's right.
One of the advantages.
RMDs, remember, required minimum distribution. The government's going to make you spend them down. Okay? And you have to start taking those out. And here's another thing. Let's say you've got an IRA split up into several beneficiaries. They only have about 8 months or so after you pass away to put them in individual accounts. If they do not, let's say they're all younger than you. I'll give you an example. Let's say you've got a third going to your 75-year-old aunt and a third going to each child, something like that. Well, if you want them to keep it in there longer, you want them to have to take out less, so it's going to help with their retirement and things. If you don't break it out within that time frame, all the required minimum distribution will be based on the oldest person in that IRA pool, which is 75. So your kids that you wanted just to help them with their retirement aren't going to be able to.
They're going to have to start taking it right away.
They're going to start taking big RMDs based on a lot older person.
Yep.
And so you always got to make sure that. Now, there's some ways to get out if you don't take a required minimum distribution as a beneficiary, it's the same thing if you don't take it as an owner of an IRA. It's a 50% penalty, not 15, 50.
Yeah.
And there is only one way to get out of the 50% penalty if you don't take it out is to completely deplete the account within 5 years.
And like I said, if you want to walk through this with us with your personal situation, we'll be very happy to. I had a lady earlier this week in her early 70s, and she split hers up amongst 3 grandchildren, very young grandchildren. Want to know if we could use that to pay their college. She was assuming they'd be close to college years, when she's gone. So if you time it right and you take the larger RMDs at that age when the child is 18 or 19 and uses for college, it may work out for you. But if not, you want to defer it if you can till they're 70, 70 and a half. Just fine tuning it. That's all.
What they're talking about putting in the name, let's say a husband dies and the kids get the IRA. It has to be put in an IRA says an inherited IRA, and it has the decedent's name.
The original owner, that's right.
All that has to be on there for the benefit of the children or whatever the child's name is. If it is not put in that name, RMDs will be based on the other person's age, which is much older.
I got a question for you off the cuff,
Uh-oh.
and I'll be up front. I didn't know the answer.
Uh-oh.
The person that inherited an IRA, which was this gal, inherited it from her brother. When she passes, and I'm assuming, without checking into it, that the brother's name stays on that through the whole course, because that's where it started,
Yes.
and that's the numbers you use.
Yep.
But she asked me, well, does my name stay on it too?
It should.
And I've got to look it up. I said, I don't think so.
I believe it'd be the original one.
Right. That's what I wasn't sure, though.
It's always the original person on the thing, but you got to make sure, because if you also have only a few months if you got a charity as a piece of
Right.
it. If the charity is not peeled off of that thing so many months after death, and then all the other ones have to take RMDs, accelerated RMDs, or no, they can't take RMDs. They got to have everything out by 5 years, all of it. And so there's a few rules like that are really weird when you get non-spouse beneficiaries. And so there's a whole, art just to putting beneficiaries on specific accounts, depending on what you want to do. Some people, you might do a per stirpes, or a per capita. Let's say you had 3 kids, but one of them preceded you. Well, you could be disowning your grandchildren on accident if you do a per capita. We can talk about that more. Remember, if you have any questions about beneficiary designations, don't hesitate to call us at 972-715-2424 or go to ilovemyretirement.com. We got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you have any financial questions or you'd like a free information kit about our company and the services, don't hesitate to call us at 972-715-2424 or go to ilovemyretirement.com. All right. Let's talk a little bit about this. There's been some confusion out there. Most people understand when it comes to Social Security. Social Security, if you and your spouse, let's say one is $2,000 a month, the other spouse is $1,000 a month. No matter which one of you pass away, the smaller one will drop off. All right? You'll always keep the larger one. The question comes when, what if you weren't taking Social Security already? The person that's, in other words, let's say your husband was 5 years older than you or whatever. Well, in your full benefit would have been less. Sometimes you can take take his benefit and then start yours at 70. In other words, take that one. If yours goes above it at 70, you can switch to your own. So it's not always you're just going to keep the higher one. Sometimes you'll take it for a period of time, and if your individual rise at 70 to above that number, then you'll kick back over to yours. I know it's a little confusing.
Well, and they've taken away a few things, or one major thing this year in doing that. But there still are some nuances that are available, and that's why the program really shines some light on things.
Right. When you do our Social Security Optimizer, it will show you. It's changed with the recent law changes just a few months ago. The best way. It also illustrates, all right, how much does it actually cost you if you live to these certain ages? Because a lot of people will do simple math. They're like, okay, I'm going to take it at 62 because it would take me to 78 to break even.
Or
Nobody's
they're
lived in
afraid it won't be there for
That's
them.
right. It won't be there. Blah, blah, blah. But they forget inflation and their cost of living adjustments, which make those numbers even more the other way. But this will show you, all right, if you do this first, and it's not always waiting till 70. It's not. A lot of times I had a couple come in the other day. It was 65 and 67. It wasn't 70. It said they should take it. And it would be 150,000 more than waiting till 70.
Side note, I was going through my mom's stuff this week for her, and they are giving 3% increase this year.
They are
Social Security. Yep.
wow.
So she got it.
They announced a 0.6 or 0.3.
I just got the letter.
You're not sure it wasn't a 0.3?
Well, that may be the
I
code.
think it was a 0.3. It was
Oops.
really bad.
Oops.
I told you that Cody got it.
Damn it.
3% would be pretty good though. Yeah, remember they had none for 2 years in a row, and I think
That's
this year
right.
they got a 0.3. They're really getting generous there at the government. Let's talk about. I looked at a few charts that were interesting to me. One of them was a lot of people use their 401k kind of as a bank, right? Because you can borrow from it and pay yourself back a pretty good interest rate. Like some of them are 6-8%. And I was looking at that, I go, that's not a bad way to borrow money if you think about it. But then they run this one chart where this person was 25 years old, basically put the same amount in. He put 6% in, his company matched 3% for the entire, 35 years before he retired. And he took out a loan when he was in his late 30s, looks like here. Late 20s to buy a house, paid himself back, and then took out another loan when his kids were in college there when he was in his 50s, and then took another pre-retirement withdrawal. He'd had $1.7 million just leaving it in there. Only had $1.1 million by taking the thing. And you wonder, well, why is it you pay the 401k back? You're putting money back into the 401k. Why would it be less? The answer is, let's say you take out $10,000. You're on like a 5-year repayment deal. So you're only getting back interest on the $2,000, even though you pay yourself 8% on the loan.
Right.
You're only getting compounding on that too. Having it out of there for that long affected you. In this case, it was a 30% more if you didn't touch the thing. My point with that whole conversation is, if you can get away without borrowing from your 401k, please do, because that can mean a whole lot. In this particular deal, this wasn't a very a wealthy person. 6% of their income. There might have been somebody making $50,000 a year, but they got up to $1.7 million if they never took those 3 $10,000 loans. So that $30,000 loans that they paid back to the 401k cost them $600,000 at retirement. It's $514,000 actually. So it's a lot of money. So if you can't help it, don't borrow from a 401k. If you can't help it, it is, cheaper money than the bank, right? It's a whole lot cheaper than a credit card. But that was an interesting one. There's also some other ones. It was talking about, let me see if I can find, life expectancy tables, how they're changing. There's been a couple articles out, studies that lately, that have shown that life expectancy is starting to go down a bit, which actually shocked me. But when you're doing Social Security planning or retirement planning, you can't think of just life expectancy. You have to think of your combined life expectancy. Because remember, we talked about this earlier in the show. If you have 2 Social Securities, you're going to lose the lower one. So you need to plan that higher one the best you can. We're going to talk about that more when we return from the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the show. All right. What we were talking about before the break is the life expectancy tables. What you have to do is you have to look at your joint life expectancy. And people sometimes don't understand that. You can't look at, all right, I'll give you an example. Both my parents died. The oldest one was 72. So if I was 70 trying to do a retirement plan, me retiring, planning on dying in the next 2 years isn't going to work, right? You have to plan on what are the odds of you both passing away, because when you do financial planning, your Social Security, but you're going to lose this smaller one. So you've got to plan that larger one to last longer than your own lifespan.
Right.
Also with your, let's say you're doing a personal pension for yourself, okay, or your stock investments. They have to last longer than you think you might live. Right now, the average life expectancy for a human being in the United States is like 78, right? But that's when you get 78 or 65, a whole bunch of people have already passed away.
That's right. The odds go up to live longer.
They go way up. And so let me give you an example. Let's say you're a 65-year-old couple right now. The odds of you getting to 80 years old, okay, 72% for a woman, 62% for a man. The odds one of them will get there, though, is 90%. You have a 90% chance of one of you getting to 90. It even gets different. Let's say if you go down to 85 years old, 54% chance women will get to 80, 85, 42% chance men. But one of you, it's a 74% chance. Even to 90, the combined life expectancy is 47%. You have to plan for a long life. I have people all the time saying, there's no way my parents lived this long, I lived this long. I'm going to spend this amount of money and it'll be fine.
That's right.
And a lot of it is economically, they have to say that to save face and everything. You know, they didn't save enough or whatever. But you can't ever argue with numbers. That's why I love running numbers, because you can argue with it, but it's not logical.
Well, you know, the difficult thing on that is it's much better to have it and not need it than need it and not have it, as long as it isn't really crimping your lifestyle.
That's right. And so think about that stuff. The other one was, why do people work in retirement? This was one of the charts I pulled up recently that I thought were very interesting. It's not to make ends meet. That's 25% of people work through retirement. Buy extras is 26%. The biggest and by far reason people stay working past retirement age is to stay active and involved and enjoy working.
Socialize, all
That's right. That's my deal. I like working.
You just want to get out of the house.
Yeah, I really like working. Having little kids at my age, that's what happens, right?
That's right.
Also, there's a couple studies here about how much you spend as you get older. You start peaking out spending in your 40s, and starts going down. By the time you're in your 70s, it gets a lot lower. That makes sense. Let's talk about, there's another chart on Medicare. Remember, if your full retirement age is 66, by taking income at 62, it's about 75% difference. It's 132% difference taking it over. It's somebody asked me, is it always 8% between 62 and 70 increase in your Social Security? No, that's from full retirement age till 70 is 8% a year. It is some other percentage before that. Let's do some questions. I think we're about ready for that. Remember, we developed this show to answer your financial questions. Anytime we get questions that I think is going to appeal to a broad audience, we don't talk about the names or anything, but we'll share them with you because we think they have a broad appeal or whatever. Well, let's go over our first question.
All right. Are you ready?
So.
Short but sweet. Answer probably won't be, but the question's short. How do I know what to invest in? Broad stroke question.
That is a really broad stroke question.
You want to go into
it just depends.
What the criteria is?
Yeah.
Or?
Yeah, you gotta have your age, your risk tolerance, your objective. Let's say you're a 30-year-old that will not risk a penny. Well, that's probably stocks are out, right? Let's say you're a 70-year-old that hates banks and CDs. Well, maybe stocks are in. The best way to start out investments, in my opinion, would be, mutual funds. And I prefer index mutual funds. And so it just depends on what stage you're in. You'd be surprised how many people have 401ks, have had 403bs forever. They really have no idea what to invest in. There's no rhyme or reason for what they have in those plans. A lot of them just chasing returns. Even though the returns could be one asset class, they might have 100% in large cap or 100% in small cap and not know that they have a real big risk of taking big losses.
Yeah, and at the risk of being redundant, the piece of advice that we'd share with you, and we've built a very successful practice on, is part of that money that you should invest in is to make sure your hard expenses, make sure you have enough money in retirement. Now number that you might need is easier to figure out when you're 50, 55, or 60 than at 30 because you really don't have a clue. But you start planning. What does it do? It eases the other investments. It can enhance those returns, and it'll give you a better criteria. But knowing how much you're going to need at retirement when you're 30 years old is a very difficult question to ask.
Yeah. The best thing to do is to have as much as you can, save as much as you can. Remember, if you start saving in your 20s, there was a chart there that I was looking at. You could save for 10 years, 25 to 35, and save that exact same amount from 45 on, and you'll never catch the 25-year-old guy.
Right.
And you're continuing to all the way to 65.
Yep.
So you can invest for 30 years. He invested for 10, and you're going to end up with the same amount of money. It is a big difference if you can start early. Anybody out there, if you can, it's hard. We're kind of a consumerism type society, especially when you're younger. I know if you're a guy, you're trying to get the nice car,
iPhone and all that
everything.
stuff.
Everything's easy on credit because they start weaning you, put you on those credit cards in college, or sometimes before.
And you're still paying off student loans, probably.
That's right. But that is the time. If you can do it, if you can put just at least your raises, like put small amount in 401k, and then at least put the raises, like a 3% raise you're going to get every year or whatever. You'll get that up to a decent number by the time you're in your 30s and 40s, and you will have a pretty good retirement. Oh, we got a break coming up, folks. Remember, don't hesitate to call us if you have any financial questions, 972-715-2424, or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080, KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Don't hesitate to call us if you'd like information. Let's say you've heard one of my commercials. You heard one of the get 7% guaranteed on your retirement savings for future income. You'd like any information, brochures on the services we offer here at Dillon Gage. Don't hesitate to call our hotline 972-715-2424. Remember, you can take advantage of our no-cost, no-obligation retirement plan, stress test, and Social Security Optimizer at 972-715-2424, or you can go to ilovemyretirement.com.
Before we went to break, we were answering the question, how do I know what to invest in? And we didn't mean to sidestep that question in any way, just wanted to let you know the enormity of it and everything that it's dependent upon. So maybe an easier way, Victor, for us to answer that is we've got a really good questionnaire, and it'll help you and it'll kind of give you some sort of direction and focus based on what we talked about, your risk tolerance, your age, how many years you're going to defer, and all the different, how many kids you have. And it can narrow that enormity, that big, huge unknown, and kind of get you laser focused. And once you're laser focused, like Victor said in the last segment, money invested early makes a huge difference opposed to trying to play catch up 10 years down the road.
And we field calls every day. And hey, what do you think about this 401k? What do you think about this? Should I roll over this IRA? Things like that. We'd be more than happy to answer those questions for you.
And if you fill out the investment questionnaire, you don't have to use us. We'd like for you to, but we're more than willing to share our tools with you to help you have a successful retirement.
That's right. 972-715-2424, or I'll go to ilovemyretirement.com.
You ready for number 2?
What's my next question?
All right. Next question would be, if I plan on taking out 4% plus inflation from my savings for retirement, do I include my home in the calculation?
No.
Yeah.
This happens all the time. A lot of people do.
They do a net worth, I know.
That's right. They want to say, okay, well, I'm worth $1 million, so I'm going to take out 4% of it. In that case, $40,000 a year. You can increase it for inflation every year, but $500,000 is in their home. No, that doesn't count. Now, can real estate count? Sure. Real estate can't count in the 4% withdrawal, but it can count in reducing your expenses. And so you got rental income of $1,000, you got $1,000 less expenses that you have to take out of your portfolio.
And I would back into this question, just reading this question, don't know this individual. Victor, you must have got the question. But when I hear someone frame the question about 4% inflation, plus inflation, and including my home, I see someone doing the math to see what the maximum amount is they can withdraw, opposed to backing into it. How much of your bills are taken care of with Social Security, pensions, investment income? How much do you need? I would focus more on how much do you need to withdraw, and then pad that a little bit if you want to do some extra things,
Right.
opposed to what's the most I can
That's right.
pull all the
'Cause
time.
invariably, somebody always makes a mistake. The 4% rule has been changed to meet people's
It's fluid.
own situation.
Oh yeah.
They'll say, well, I am worth this much. And it's 4% of your liquid assets. Real estate is not a liquid asset. Now, remember, if you have rental properties, I wouldn't take 100% of that because you might have vacancies here and there,
Maintenance.
But take a percentage of that and knock it off your expenses. Okay? Don't take it add it to the 4% rule. It's only your liquid like your mutual fund, stocks, bonds, cash. That is the stuff that you can take 4%. But remember, end of 2013, they redid the numbers and said the only safe withdrawal rate is 2.8%.
That's scary, isn't it?
It is scary. It's
That
not
means
going
you
the other
need
way.
twice the amount of money that you did at 4%.
Ugh. So, and that's why also the reason fixed annuities and fixed index annuities have become so popular in the last few years. Because people say, I've got $1 billion liquid portfolio. You mean to tell me I can only take $28,000 a year out of it?
Yeah, go figure.
And that gives you a 90% chance of not running out. Doesn't even guarantee I won't run out. When they can get 60 to 100,000 a year on that same portfolio using an index annuity, well, that's much better for someone. So they'll say, wait a minute.
Guaranteed absolutes.
That's right. I got a 90% chance of not running out on $1 million, but if I do an annuity, I will get 70 to 100,000 a year and 100% chance you won't run out. So that's why they're so popular right now. It's not because people are selling them more, this and that. It's because of low interest rate environment, volatile stock market, and people get close to retirement. They need to start putting some of that money towards an income stream or need to produce an income stream, and dividends and the withdrawal rates aren't high enough.
And it's exciting now with the market going and all the new possibilities we have next year with Trump. It's a lot easier for people to take some money now and carve it out and get the fixed annuities and get their income taken care of because they're feeling that strength of the market. We can see the influx of calls.
Yeah, don't remember when it comes to. Well, go ahead and go to the next question.
You want to get to it?
Yeah, we got a minute for it.
All right, let's go. If I plan on working past age 65, do I still have to enroll in Medicare even though I'm staying with my company plan? Good question.
No, you do not have to enroll in Medicare Part B, but you do within 8 months of leaving. Because if you don't, that's called a special enrollment period.
Right.
If you do not, you'll have to wait till the I think January through March is the enrollment period. And so you could go without pay, without being covered. Also, some of those retiree plans and COBRA plans, you have to go get Medicare B because they'll become the secondary insurer.
That's right.
Not when you're still working there. It's a retiree and COBRA plans. They'll become the secondary insurer, and what you'll get is you'll get bills saying, we're not taking this claim. You're like, wait a minute, I've got this insurance. You got to make sure you do the Medicare rules correctly. If you have any other questions about that or anything you've heard on this show or anything you've heard from us on our commercials for the last 20 years, don't hesitate to call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always, always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.